Hello, everyone. This is a quick macro update from Zacks Professional Services. I'm Mayur Thaker. I am an analyst and senior relationship manager here at Zacks. And today is Tuesday, March 29th, 2022. So let's get started here. There's a couple of things that I wanted to share with everyone here. As you know, rate hikes are on the minds of all investors right now. As we know, the Fed had raised rates by 25 basis points at the last meeting and are essentially guiding for further rate hikes throughout the entire year. So I wanted to kind of take back a look at history and utilize the data and data visualization tools within ZRS to understand, what's it been like in the past when, the Fed has raised rates? What has happened historically to markets? So we have in here a number of tools that we can use within the interactive chart, area. And this is also available within Zacks Advisor tools as well. So I just created a custom chart where I looked at the federal funds rate historically versus the S&P 500. And I am using right now the S&P 500 total return index. So the numbers are a little bit different from what you might be used to seeing. This is not the price index that you see quoted throughout financial media. This is the total return index. So it gives you a true picture of the total return that the index has delivered over the years. And so this is a chart going all the way back to the 70s here. So we have a good amount of data, which captures the last time we had, hyperinflation, which is kind of what everybody seems to be comparing to today, given, the CPI is registering very, very high readings, basically the highest we've seen in about 40 years. And so now that we're heading into a rate hike cycle, we can kind of take a look at what has happened to the market historically whenever the Fed has raised rates. And you can see that started to happen, at the very tail end of 2015, the last time. Prior to that, it was in 2004. Prior to that, late 1999, or I should say early 1999. Prior to that, 1993 and so on and so forth. So, I just compiled a quick, table of data that shows, when the month end of the first rate hike, during that rate hike cycle. So the first time that the Fed raised rates after, going through a cycle of cutting them, right? So the last time that happened was under Janet Yellen in December of 2015. So the start of the S&P, I just took a note of where the S&P total return index was at the beginning of that, and then where it was after 1 year. So you can see that these are, each of the last several initial rate hikes, not the end of the rate hike cycle, but the very first rate hike. So at the very start of that rate hike cycle. And you can see that, these are the S&P 500 total returns exactly 1 year later. So on average, the market is actually up by about 5.7%. So there have been a few times where the market was down, but really not by much. In 1987, that was one time, that the Fed started raising rates. That was during that stock market crash of 1987, but it ended, on not such a bad note, just down 3.3%. Prior to that, 1977, so that takes us way back, during the starting of that inflationary cycle, where the market was down 8.3%. But even during the thick of that recession, right, when interest rates were very high, the S&P still returned a positive, return of 5.4%. So this is on a total return basis. So, this basically just goes to show that, rate hikes are not to be feared. It's really not rate hikes that, may or may not drive the S&P total return. This, obviously does alter the benchmark rate that everybody uses to, price, future cash flows and discount them back to present terms. That certainly goes into, equity calculations. So all things held steady, higher interest rates, on paper, at least academically speaking, lead to lower PE multiples. But, that certainly oversimplifies it because, Higher rate cycles can coincide with either high inflation, or it can also coincide with an expectation of future growth, right? And I'm not going to take a side on that just because the Fed is saying that, but there's multiple sort of factors that go into what determines the S&P total return. And I just wanted to kind of use this exercise to illustrate the simple point that we shouldn't fear rate hikes, right? That's just not something that historically the market has, sold off on, just that in isolation, right? So our key idea here is rate hikes by themselves are not to be feared. Earnings growth and earnings outlook is much, much more important than anything else. So, this is kind of where I, would like to lead into the next section. If you recall up my previous calls, I've been watching very, very closely just a handful of macroeconomic indicators, because as we know, as of February, we got a very, very high CPI read. It's been going up and up. So this basically takes us way back to the 1980s. Really, you have to go way back to see a higher CPI read. So this green line right here is the year-over-year percent change of the CPI headline index at 7.9% as of February, which we just found out pretty recently. That takes us way back to 1982 to get a higher reading here. It's almost taking us to 1981. So again, these are extraordinary numbers that we're seeing here. But as you can see, that there's a very strong relationship between the CPI index and the ISM backlog index. This is the manufacturing backlog index. So of course, this is something I'm watching very closely. I was hoping that this trend that we started seeing as of the summer of 2021, where the backlog was finally starting to ease, I was hoping that that would be the leading indicator to the CPI finally coming down. But it looks like, the backlog index once again popped up again back to 65. It got down to about, 56. So that was a very positive trend, but it once again, that backlog just snapped right back up. So that's definitely not good for the CPI. So, as long as this backlog index remains elevated, I see really no end to the CPI finally coming down, barring, say, a recession. But even if a recession were to occur, the backlog would come down because of falling demand. So that leads to the next part of it, is that we want to see, two things happen. We want to see the backlog index come down, as well as demand remaining strong. So that leads us to the next item here, which is factory orders. This is one of my favorite indicators to show the health of the U.S. economy. Factory orders is one of the leading indicators of economic cycles. And you can see here that factory orders are very, very strong. You can see that it has basically recovered the entire COVID, dip, and we're basically back to long-term trend growth. If we were to draw a trend line here, you can see that the current reading is essentially back to where we have always trended for this entire decade. So that's very, very good to see. So that means that the backlog is high, not due to any other issues, but production issues, because demand is very, very robust here. So we're seeing factories orders for unfinished goods or inputs, manufacturing inputs remain very strong, but it's telling us that manufacturers of those raw materials, of those raw inputs, are simply not able to keep up with this demand. This is the demand side of the equation. And backlog measures that supply and demand imbalance. So as long as we see factory orders remain strong and at trend growth, you can see this is on the bottom panel is the year-over-year percent change. That's coming in at 6.76%. That's essentially at the upper end of where we have been this entire post-2008, period. It is trending down, but again, that's mainly because we are rallying off of a very depressed base. But you can still see that, now that we're, through 2022, the comps are much, much more, favorable. now that, we're comparing, today's numbers to 2021, we're out of that, depressed area of the recession that was forced by COVID. So the comps are much, much better, and yet we're still at very good numbers here. So I expect this to come down a little bit, but that's nothing to sort of, worry about, just because this is simply returning back to trend, as we see in this raw, index that we see on the top panel here. So demand remains very strong. And lastly, there's a little bit of a mixed picture here, because as factory orders remain strong, the Chicago PMI is actually rolling over, right? And you can see that there has been a very, very strong correlation. In fact, the Chicago PMI leads the S&P 500 earnings. So you can see over here in the blue line, this is the Chicago PMI. This is a reading of the pulse, essentially, of the Rust Belt of the United States. So, the entire Midwestern region where many manufacturing facilities are located. This is a reading of the pulse of how they are doing. And amazingly enough, the Chicago PMI determines the direction of the S&P 500 earnings. Almost to perfection, you can see that here. So as the Chicago PMI goes, so does the S&P 500 earnings. And so now we see that, as the Chicago PMI really crashed heading into 2020, it rebounded, so did the S&P 500. But now look at where the Chicago PMI is headed now. So I am a little bit worried as to what this means for the S&P 500 earnings. As we see this divergence here, sometimes this does occur where the PMI rolls over in advance of the S&P 500 rolling over. So it's still at a expansionary reading here. It is above 50. So keep in mind, anything above 50 means that the economy is expanding. Anything below 50 means it's contracting. So it is above 50, so that's still good to see. But that rate of change is a little bit worrying here. But let's see where this takes us over the next couple of months. If this does fall below 50, I would start to get worried that, S&P 500 earnings may start to slow down and start to come down a little bit here. But again, these are very strong comps. The year-over-year percent change on the S&P 500 earnings growth is still very strong. So even if this, number, again, this is looking at the S&P 500 year-over-year percent change in the earnings picture of the S&P 500. So even if this year-over-year percent change does roll over a little bit, that's not necessarily bearish. We're at 50% right now, 51%. Even if this rolls back and kind of corrects back to its longer-term trend of, closer to, say 20% or so, even 15%, that's still, that's not necessarily bearish for the markets. It just means that the rate of change is beginning to slow. So the Chicago PMI is very much an important number to keep an eye on as well. So this is on the supply side of the equation. Factory orders are on the demand side. Chicago PMI is one of many indicators on the supply side, on the production side. And I just wanted to also just quickly highlight to you this extraordinary correlation that exists between the Chicago PMI and S&P 500 earnings year-over-year percent change. So overall, I would not fear rate hike cycles. Just sort of in conclusion, if the Fed rate hikes are really just does not have a very good track record of predicting, say, a negative return on the S&P. We've had only 2 times that has occurred. One of them is very mild. So really only one time in the last 50 years, really, where we had, a sizable, decline in the market. And that too was about 8.3%. So nothing crazy, nothing, catastrophic, I would say. And we've had a few instances where we've had a very strong return. The most recent being in 2015 / 2016. The S&P was actually up overall, despite multiple rate hikes during that period, as you can see here. So rate hike cycles are not something to be afraid of. The CPI is going to be here to stay. I think inflation is going to remain for some time, as long as this backlog remains high. On the demand side, factory orders still remain very strong. So I see nothing to be alarmed about here. And then just, to keep an eye on the Chicago PMI, it does look like it is pulling back, but it is still expansionary as of right now. So I would just keep an eye on the Chicago PMI here as well. Hopefully it does not fall below 50. But I would expect the S&P growth in terms of earnings growth year over year to be coming back a little bit here as the Chicago PMI does ease up. But as long as this remains above 50, again, these are, very overall positive numbers. But this, again, this is very important to the backlog. Since this is, again, on the production side, the supply side, this measures manufacturing strength. We need this number to rise up if we want to see that backlog come down. And this number is not coming down. So it's, this number is not going up, right? We want to see Chicago PMI go up if we were to see backlog come down. If backlog comes down, then CPI comes down. So again, this is a very interesting cycle, but we really need to see manufacturing pick up. We need to see production pick up if we want to see backlog come down. Why do we want backlog to come down? Because that is the key to inflation coming down. And if inflation comes down, purchasing power of, the middle class goes up. And that, again, is very bullish for the U.S. economy. So, these are the key indicators I'm watching. So far, nothing to be super concerned about. But these are the numbers that I would keep watching very closely to make sure and continuously challenge our overall worldview of where the S&P 500 index is headed. So hopefully this was helpful. If you have any questions or if you want any of these slides, please do reach out to us. You can see our contact info right here. If you're a ZRS client, please do email us at zrs@zacks.com, or if you're an Advisor Tools client, zat@zacks.com. Thanks, everyone, and hope to see you soon again for the next one. Take care.